Hey everyone, welcome back to the TraderLion podcast. I'm your host, Richard Moglen, and joining us today is a fantastic guest, Kenny Polcari. And Kenny began his career on the New York Stock Exchange as a floor trader back in 1985, and he is currently the founder and CEO of Case Capital Management and Secret Market Strategist of Slatestone Wealth, which is over $1 billion in assets under management. Kenny, thank you so much for taking the time, and welcome.
Well, thank you very much. It's a pleasure to be here, and I look forward to this.
Yeah, me too. And to kick things off, I kind of love to hear about people's backgrounds and how they first got interested in the market. So I love to hear the story behind, how you became a floor trader back in 1985.
So listen, that's going to take up the whole. That's going to take up the whole podcast, because I could talk about that. I could talk about that for hours. But I was a typical 18-year-old kid going to college, not really having a clue on what I wanted to do. I was going to school in Washington, D.C. because I thought that I wanted to be a politician and then a lobbyist and then ultimately the president of the United States, which thank God none of that happened. And I had, during my freshman year in college, I had the opportunity to go visit New York and visit the New York Stock Exchange, and then was offered an opportunity to intern there in the summer of 1980. Now, look, I wasn't a kid. I'm not from New York. I'm from Boston. I'd never been to New York City. I thought to myself, I spent my summers on Cape Cod. I thought to myself, why do I want to go to New York City at 19 years old when I could go to the Cape and be a lifeguard on the beach after my freshman year in college? And so my first reaction was, nah, I don't think I want to do that, right? I didn't want to go to New York. Why would I want to go to New York City? So I thought about it over the Christmas break. And at the beginning of the spring semester, I changed my mind. And I thought, okay, listen, what's the worst that's going to happen here? I'm going to go there. I'm going to have this experience. I could chalk it up and put it on my resume. And if it's a great experience, it could change the course of my life. And if it's not a good experience, I'll just chalk it up and move on. Well, in fact, I went there in the summer of 1980, and it changed my life, right? I walked on the floor of the exchange in May of 1980. And what you have to remember, well, you won't remember this, but what you have to understand, in 1980, we had just come through the Jimmy Carter years, right? We had just come through the Iranian hostage crisis. The country was morally bankrupt. We had just come through this oil embargo crisis, and the economy was in a shambles. Inflation was on its way to 13%. Unemployment was on its way to 10%. And Fed funds and interest rates were on their way to 21%, right? That all didn't happen until we got into 1981 and 82, but it was on its way, right? In 1980, the economy, Ronald Reagan had just been elected. Well, in November of 1980, he had just been elected president, and January of 81, he became president, right?
Right.
And so I was there during the summer of 1980. And if you've ever been to the New York Stock Exchange, and even if you go there today, you're not even going to experience what I experienced, because it's vastly different today. Today, it's all very technological. It's run with computers. There's 200, less than 200 people that work there today versus the 5,500 Type A personalities that ran around the floor in the building in 1980 and 81, all through the 80s and 90s, and up until, really about 2006 or 7. But what ended up happening was, I walked down to the floor. I got this exposure to this most amazing place, and the energy in the room was dynamic, and it was exciting, and it was all Type A personalities. And if you know anything about a Type A, they feed on each other's personalities, right? They feed on the energy. And I'm very much a Type A personality. So I walked down on the floor, and I was just transported to this other place, because the energy was up here, and the personalities were they were interesting, they were exciting, they were funny, they were serious, right? Because part of what made up the personality of the New York Stock Exchange were the people that actually worked there, right? Not worked for the exchange. I worked on the exchange. I was not an employee of the New York Stock Exchange. I just had a business on the floor of the exchange, right? And so the brokers, the specialists, the brokers, the clerks, were all very dynamic people, right? Most of them were Type A's. If you were a Type B, you got run over, let's be honest, just because it didn't suit you, which is why it was so exciting. And so, when I first went there, it was very much like being transported to a foreign country. You didn't speak the language. You didn't understand anything that said. They spoke in a certain way. If you were a buyer, you spoke one way. A seller, you spoke another way. You spoke in fractions and symbols, because everything had a symbol, right? Everything had 1, 2, or 3 letters. Today, they go up to 4 letters on the New York. That only changed when back in 2006, 7, when they started to integrate both the markets, right? But it was either 1, 2, or 3 letters long, and you had to understand and know what the symbols were, right? If somebody called you up and said they needed to buy, 100,000 shares of burgers, you better know damn well what they wanted to buy, or if they wanted to buy Big Blue, or if they wanted to buy hot water pipe, you had to know what that was. Now, hot water pipe was Hewlett Packard, right? It was HWP, right? So if somebody wanted Hewlett Packard, they'd say hot water pipe, or burgers was McDonald's, if you might imagine. Beamer was IBM, or Big Blue was IBM, right? Could be interchangeable. Somebody said Coca-Cola, you had to know the symbol was KO, right? You had to know those things. Raytheon, RTN, I mean, all these, and I say Raytheon because early on I had an error in Raytheon because somebody called me, a client called me up and gave me an order to buy RTN. They said it that way, RTN, but I heard RPN. And so I wrote RPN, not RTN. And because they gave it to me as a market order versus a limit order, there was no price on it, so that you weren't able to catch the error, right? Because if they had said to me, buy 1,000 shares of RTN at $22, and I wrote buy 1,000 shares of RPN at $22, RPN didn't trade at $22. So then you would have known right away there was a mistake. Well, the fact is that I got the symbol wrong, and since there was a market order and a limit order, no one realized it was a mistake until after we bought the stock, right? So you had to know all those things, and it took a little bit of time to learn it, for sure, right? Just like being, somebody picked you up and put you in Japan, you can't speak it, you can't talk to these people until you spend time and you understand the language, whether it's Japan, whether it's Germany, China, France, Italy, whatever. It's a foreign language, right? And so it was very much that. But I spent the summer of 1980 asking questions, reading a lot of newspapers, getting a lot of coffee, because that's about all you did, right? I was 18 years old. But I was learning, and I was listening. I was listening to the language and and so that's how you learned, right? You were thrown right into it. I was writing reports, and so you were getting used to symbols, you were getting used to fractions, the way that they were written. And remember, in 1980, right up until the turn of the century, we were trading only in eighths of a dollar. So there were only 7 price points at which to trade. Between $20 and $21, it was an eighth, a quarter, 3/8, half, 5, 7/8. That was it, right? Those are the only increments you could trade. And so it was a very dynamic, exciting place. And so it bit me. By June of 1980, it just bit my backside, and it wouldn't let go. And I stayed there until August. I went back to college in my sophomore year, and I decided then, when I went back to college, that screw the Washington D.C. lobbyist, political science, president of the United States bullshit, and move on. And so I left D.C. I moved back to Boston. I transferred to Boston University School of Management, and I finished my education there. But I went back in the summer of 81. I went back in the summer of 82. And what's really interesting for people just to understand this, by 1982, the economy and the U.S. markets were in a complete sell-off. It was just horrendous, right? Inflation was now peaking at 13%. Unemployment was peaking at 10%. Guys that were my age then, right? I'm now 60, but guys that were in their 50s and 60s were getting thrown out because they were the expensive guys, right? Kids getting out of college couldn't get a job because companies weren't hiring. They were just kind of downsizing and managing with what they had, right? And so when I went back in the summer of 82, I went back to go work for the same broker that I had spent the summer of 80 and 81 with. Mm-hmm. Well, the poor guy was an independent broker, and he was a lovely guy. And I adore this guy, but he was basically going out of business because, when rates were 21%, and you could take your money, if you were anyone who had any money in the world, and you could take your money and go to the bank and give it to the bank, the guy at the bank was going to put it in a CD, and you were going to earn 22% risk-less, guaranteed sleep at night. Yeah. Versus taking your money and buying, GE and American Telephone and Johnson, which are fine U.S. companies, but they're full of risk, especially in an economy that's collapsing, right? So what's your choice? Your choice is you're going to go put your money in the bank, and you're going to get paid 22%. Think about that. Think about 22% on your money. So you got $100,000. At the end of the year, you got $122,000. And at the end of the following year, you got $148,000. And the next you got 100, right? That you weren't going to get those kinds of returns. And so therefore, what was happening, same like it was happening everywhere, is that this guy was going out of business because people were not investing in stocks, right? And so this poor guy, I came back in May of 1982, and he put his arm around me and said, I'm sorry, I just cannot afford another bill. Now, understand I was making $125 a week. $125, right? So it was $500 a month. It was just an extra bill that this guy couldn't afford.
Right.
And so now here I am going into my senior year in college. And I thought, okay, maybe this is the summer I end up going back to Cape Cod and being a lifeguard on the beach, right? But I had spent 3 summers there already, 2 summers there already. This is my 3rd summer. I knew a bunch of people that worked on the floor. And so I walked around and other brokers that I had known, and this one broker who I absolutely adore. I adore this man. He's now in his 80s. He lives out in Long Island, but I adore him. He saw me, puts his arm around me, welcomes me back. It's so excited to have you back, blah, blah. He had a different business model. His business model was option layoff business, which was beginning to explode. And it was connected to the option players in Chicago, how they had to hedge your option positions with stock positions. And so that was an area of the business that was exploding. And this guy was right in there. So he actually had a business that was thriving versus the other guy had a much more traditional business, right? And his business was not thriving. So this guy puts his arm around me. Welcome back. Nice to see you. How's this? How's that? I said to him, everything's great, Mr. Latham. I said, but, I'm probably not going to be here this year because Doug can't have me. Doug just can't afford to have me. He goes, what do you mean Doug can't have me? I go, he's not doing very well. His business not doing very well, and he can't afford to have me. So I'm coming by basically to say goodbye. And so this guy looked at me and he said, absolutely not. He said to me, do you know the difference between a buy and a sell? I go, yes, sir. Do you know the symbol for IBM? I go, yes, sir. He goes, do you know the difference between an 1/8 and a quarter? I go, yes, sir. It's 12.5 cents. Great. How's $2.50 a week? $2.50 a week? I just got a raise, right? And I was like, when can I start? I'll start right now. And so, in fact, I went and it was the summer of 82. And I went now to work for this other independent broker. And I was there with him through the whole summer, but I was there with him on the day in 1982. It was August 17th. I will never forget this. When the Fed then made the announcement, Paul Volcker was Fed chair, and they made this surprise announcement on a Tuesday morning, which the Fed never did. Well, you got to understand, back in the 80s and 90s, unlike what the Fed does today, where they hold your hand and lay on the couch and take a Xanax and make sure that you agree with what we're doing, because if you don't, then we won't do it, right? The Fed never did that. The Fed would come out, they'd open the door, they'd one person would come out, stand at the podium, open up his folder, he'd say, here's what the decision is, here's what we're doing, he'd fold it up and he'd walk away. There was no press conference, there was no time for questions, there was no holding my hand or come and lie down on the couch and take a Zoloft and let's talk about it. None of that. He just came out, they said that what they were doing, and that was it. And so on this day, on the Monday, actually, there was a rumor started late in the afternoon that was going around the floor that the Fed was going to make the surprise announcement on Tuesday. Now, remember, there's no internet, there's no LinkedIn, there's no Facebook, there's no Twitter in 1982. And so the way that the news traveled around the world was by telephone and by newspaper, which is the way that it always traveled around the world. And so when the rumors started on the Monday afternoon about the Fed coming out on Tuesday morning, make the surprise announcement, nobody really believed it because the Fed never did that. They would come out on Thursday mornings at 8:30. So the Tuesday morning thing, everyone was like, it can't be, not true. But remember, we were in a really the economy was in a really bad spot. And there was lots of conversation about the economy and blah, blah. So on the Tuesday morning when we came to work, it got to be about 8:30, close to 8:30. And suddenly there's kind of a hush on the floor, not quiet, but people are kind of waiting to see what happens at 8:30. Now, remember, there were no televisions on the floor. There was no CNBC. There was no Fox. There was nothing. The only way we were going to find out if anything happened at all was when the news hit, when the news hit the tape and people off the floor saw it, either on Bloomberg or on the news or through a news wire, and they picked up the phone and called down to the floor. So it was about 8:30 and 30 seconds, and every single phone on the floor lit up like it was Christmas. And they were phones, they were these big industrial metal phones. Unlike today, they're all these fancy phones and they play songs and bells and all that stuff. But then they were these big industrial phones that had rings, like a ring, right? Every phone on the floor lit up and rang at the same time. You felt like you were in Times Square. It was unbelievable. And what had happened was they came out and made the announcement that the Fed was cutting rates. Get a load of this. Rates were 21%, right? They were cutting rates by 10%.
Wow.
10% is 2 percentage points,
Wow.
right? But today, contrast that today, they're talking about raising rates by a quarter or 1/2 of 1%. And everyone's having a nervous breakdown, right? But then they made this announcement, and it was a surprise announcement because it was on Tuesday and no one expected it. And they came out and they cut rates by 10%. And that day was the birth of the greatest bull market this country and world has ever known. It was August 17, 1982. I was 21 years old. I was there when it happened. As I'm sitting here telling you this story, I can feel the sweat running down my back because I can put myself right back in that position. But it was at that moment that I just said, this is it. If I even had a question about what I was going to do, this was it, right? So I stayed there to the end of August, and I went back to college, and my senior year, and I went to back to Boston. But what was interesting was at the end of August, when I was going back to school, this broker said to me, "Listen to me. If you're interested, you have a job upon graduation," which was the following May, 9 months, 10 months away. He goes, "I think I'm going to pay you $36,000 a year." Dude, $36,000 a year in 1982 was like you hit the lottery, right? And I was a 21-year-old kid, and kids that I was going to school, they couldn't get a job. So I went back to college my senior year and had the time of my life, right? Because I had a job when I graduated college. What I didn't do, and it was probably a mistake, but maybe it wasn't, was I didn't put myself through the process when I went back my senior year in college. I didn't write a resume. I didn't go on interviews. I didn't go looking for a job because in my mind, I had the job I wanted. So why would I screw it up and try to interview somewhere else? So that's how I ended there. That's how I ended up there. And then I graduated in 1983, and I moved back down to New York in July of 83 because I took a month off and went to Italy just because I was 22 and when was I going to get a chance to do that again? But I moved there in July of 1983, which I honestly thought was going to be a 2 or 3 year stint. And then I was going to, move back to Boston and get a job at a big fancy investment bank and all that shit. Meanwhile, none of that happened. I met my wife on the floor of the New York Stock Exchange, and we started dating. We got married. Next thing you know, 40 years goes by, and life happened, right?
Yeah.
But it was an amazing time in history. And it was an amazing time for the markets. And I'll be honest, I happened to be in the right place at the right time. And I happened to be a type A personality that fit that mold.
Right.
And I'll tell you, but I'll tell you something else. I was in the right place at the right time because I was offered an opportunity and I made a conscious decision, right? Now, look, like I said to you, my first reaction was, nah, I got no interest. Had I stuck with that, nah, I got no interest, God only knows where I would be today or who I would be or what I would be. I have no idea, right? Maybe I would have been a politician. Maybe I would have been a senator or a congressman or a lobbyist or something in D.C. But I got to tell you something, based on the career I had versus the career I thought I wanted, this so blows it away, right?
Right.
And so that's kind of, I don't know, short and long of how I ended up there. I could talk about that whole period of my life, the whole podcast if you want, but we can move on.
Yeah, no, that's great. It's funny you say you spent a lot of time in DC because I'm from Maryland, right near DC, so I know that pretty well. Did you go to American, by the way?
I went to American.
That was my guess. Yeah.
I had a brother who went to Georgetown.
Yep.
He was a year older than me. And I wanted to go to Georgetown, except Georgetown didn't want me when I graduated high school, right? Because I didn't fit the bill. I had my SATs, whatever, right? So I go, okay, so let me go to American. I'm going to do really well for a year, and I'll transfer.
Right.
And I did. I did really well. I was at the top of the class at American after my freshman year, blah, blah, blah. But I had this experience over the summer, right? So which then started to change my whole mind. And I go, you know what? I don't want to stay in DC because now I don't want to do this anymore.
Yeah.
So then I went back to BU. And I could have gone, I guess I could have gone to school in New York City if I wanted to, at Pace or something like that. But I went back to BU partly because I love Boston. I grew up there. I think Boston's an amazing college town. Mm-hmm. And so I took advantage of being in college in Boston and had the time of my life. And look, part of it, I spent, by the time I got back to BU, it was second semester of sophomore year. So I'd spent 3 semesters in DC. Then I spent spring semester of sophomore year. Then in fall semester of junior year, I went to Italy for 6 months because I went to study abroad. So then I got back. So I spent the spring semester of junior year and then senior year in Boston. So I wasn't, and then I spent every summer in New York. Right. So I was very active, and it went by before you knew it. But going to school in Boston, honestly, for me, it was great just because Boston, I love the city, and the city is a college city, right? There are 26 colleges within Boston. So there's young college kids everywhere. So it was great. I loved every minute of it.
Yeah, perfect. And, thinking back on really interesting periods of times which I'm sure you experienced on the floor, I'd love to hear some stories about, the crash of '87 and also the roaring bull markets of the '90s, because I'm sure, that was probably a really amazing time to be a floor trader.
The whole thing was amazing. So it started, like I said, on August 17, 1982, when the birth of that bull market took hold, right?
Right.
And so from 83, 84, 85, 86, the market just exploded because what the Fed did back in 1982 was draw the line in the sand. They were cutting rates, they were cutting interest rates. And so when they cut interest rates, what did that do? It forced money out of where? Out of the banks and into the market, right? The same way we saw during the great financial crisis when they cut rates to zero, they forced money into the market. We had this massive rally in the market, right? Which is now we're going to go through this correction phase. But one way or the other, in 1982, the same thing happened. They drew the line in the sand that they were cutting rates. And so rates over the next couple of years, after that initial rate cut in 82, through 83, rates came down, they came down, they came down, they came down, and ultimately they normalized around 4 to 6%. But think about that, 4 to 6% down from 22%. And so money was forced out of the banks into the market. So in 80, 82, 83, 84, 85, 86, the market just had these incredible gains. Right. So what started to happen in 1986 was this school of study, which did not exist when I was in college, and I graduated in 1983, was a thing called quantitative analysis. And that's when they started using computers and algorithms, and they were doing, automated valuations. And it was in retrospect, it was very crude at the time because it was very new, right? But it was becoming a burgeoning part of the landscape. Mm-hmm. And so these group of guys, and they were academics, they were engineers, they were I'm going to say computer nerds because that's what they were at the time, right? They were nerds.
I don't take offense. I'm an engineer, so I'm not taking offense.
But the engineers weren't the nerds. It was the computer guys.
Gotcha.
And so they were not finance guys. They were not economists.
Right.
But they were mathematicians and they were engineers and all that. And so they decided now they were the ones using, all of a sudden this quantitative analysis and computerization and all that stuff became, quite popular. And so they came up with a product that they called portfolio insurance. And it was an automated product, right? That was supposed to take in data from the US markets, from all the developed markets, right? From the US, from Asia, from Europe. And it was supposed to take in all this data. It was going to run through this massive IBM supercomputer. And then based on what the computer spit out, it would either spit out an action or not. Now, listen, insurance is exactly that. Health insurance, disability insurance, life insurance. It protects you against some kind of a loss. This was called portfolio insurance. And so the portfolio insurance product was a product that these guys designed that was designed to protect you, the portfolio manager that's managing 100 million, a billion, 2 billion. It was designed to protect you and your portfolio. This was not a retail product. It was an institutional product, right? And so these guys built this product. They quote unquote back tested it. It wasn't in real life. They were just back testing it with data, right? But here's the thing. When the market's going up and up and up and the economy is getting strong and strong and strong, the computer never suggested you should do anything. So in fact, you don't do anything. Like when you have disability insurance, you pay for it every year, but if you never become disabled, you never use the insurance.
Right.
If you become disabled, suddenly you use the insurance, right? So in this case, they back tested. Oh yeah, we got it. It works great. Blah, blah, blah. We're going to protect your portfolio. So they went around and they sold this product to institutional asset managers around the world, US, in the developed Asian markets and the developed European markets. So think about Europe. You're talking about continental Europe, the UK, France, Germany, Italy, Spain, right? When you think about Asia, you're thinking about Japan, Australia, Singapore. China wasn't a piece of this puzzle because they didn't even, in terms of exist, they didn't exist at the time in terms of the developed markets. And quite honestly, they're still not a developed market. They are still in the emerging market category, believe it or not, but that's a whole other conversation. And they sold it to institutions here in the United States. And so their claim to fame was, we're going to protect you. All these gains that you have over the last 5 years, the market was up. The Dow on August 17, 1982, traded at 792. That was the level of the Dow.
Yeah.
By the summer of 1987, the Dow was trading at 2,800. It was a massive, massive move, right? And so there were these massive gains, and people that were invested in the market, it was like the roaring 20s. I mean, you were just printing money, right? But these guys decided that they were going to create this product and they're going to sell to all these institutional asset managers, which they did. And so now you, as an institutional asset manager, your company bought this product. So now in the summer of 1987, we've had these 5 years of this incredible growth in the markets and the economies and blah, blah, blah. But remember, there's still no internet. There's still no LinkedIn and Facebook and Twitter and all that crap, right? And news still travels around the world by newspaper and by telephone, people talking, right? And so in the summer of 1987, the global economy started to sputter a little bit. It was, some of the economic data was starting to weaken, and it was in Europe, and then it was in Asia. And so the markets were having these kind of fits and starts, which was completely reasonable considering the move that we had, right? So it started as we moved from August into September and October, which are typically volatile times of the year anyway. The markets, global meaning, they started to kind of have more dramatic moves, and there were consistent days of markets under pressure, and then consistent days again of right. But it was very specifically the week of October 14th, 15th, and 16th. It was the Wednesday, Thursday, Friday of that week in October, where on the Wednesday the market came under pressure and it traded on elevated volume and it closed on the low of the day. And then overnight the Asian markets kind of had the same reaction, and European markets had the same reaction. And then on Thursday, the US markets opened again, traded down, just down, and then closed on the low of the day. And so it was getting a little bit ugly. And so these guys with the portfolio insurance were taking all the data, all the economic data, all the price data from the US, from Asia, from Europe. And then on Friday came. The markets were really weak around the world. And in the US, the market opened lower and just traded straight down. I don't think there was a plus tick at all on the Friday. And again, it traded on elevated volumes and it closed on the low of the day. Now, I went home that night, and I was 26 years old, right? My daughter had just been born. We just bought a house. I had a 15.5% mortgage on my house, because that's what mortgage rates were at the time, right? My daughter was just born. She was 6 months old. My wife, who I met on the floor of the exchange, who worked there for 13 years herself, was a member of the New York Stock Exchange and completely understood. When I would come home and I could talk about it, she could completely understand what I was talking about. So I came home on that Friday night and I go, something doesn't feel right to me. But what the hell do I know? I'm 26. I have no experience. But it just, in my gut, I felt like there was something wrong, right?
Right.
But now the weekend came. It was Halloween. My daughter was 6 months old. We did the pumpkin thing and blah, 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 jumped in the leaves and did all that shit, right? And then on Sunday night, I go to bed. Now, on Sunday night, I pick up my phone and I check on CNBC. I see, what are the futures doing? What's the Asia? I couldn't do that then, right? But Sunday night, I go to bed. Now, understand something. Sunday night in New York at 9 p.m. is what time in Asia? It's tomorrow morning at 9 a.m. Right. They're 12 hours ahead of us. So we're going to bed on Sunday night, and they're getting ready to go to work on Monday morning. Over the weekend, the portfolio insurance guys had taken all this data from the week, the macro data, the pricing data from all around the world, and shoved it into this IBM computer. And the IBM computer spit out an action on Sunday night. Now, Who's the first? Asian markets are the first to open. Sunday night, it's Monday morning in Asia. So we're sound asleep. The Asian markets are the first ones to open. So anyone in Asia, any institution in Asia that bought this service got a message. You need to sell 2% of your portfolio to protect it. You're going to raise cash. You're going to put the cash over here on the side. It's going to remain in cash until we get through this volatile period. Then we're going to put this cash back to work. That's how you're going to protect your portfolio in simplistic terms, right? So the Asians were the first ones to get the message. 2%. That's what they had to sell. So you're in Asia. You manage a portfolio that's got 100 million. I manage a portfolio that's got $1 billion. My 2% is very different from your 2%, but it's still 2%. You understand?
Yep.
So Asian markets started to come under pressure. They were the first markets to open with this message. So now I'm sleeping, right? Now it's 1, 2, 3 o'clock in the morning. I'm still sound asleep. Meanwhile, the Asian markets are coming unglued. But now what happened is because now they see the reaction in Asia, how the markets now started to sell off, and the market started to sell off fairly substantially, that these portfolio insurance guys took the data from Asia, from the trading day on Monday, and fed it back into the computer. And now the European markets, the sun moves around the world this way. So when Asia closes, Europe opens, right? So now the European asset managers, now the computer spits out a new message based on what had happened 6 hours ago in Asia, right? And so the European asset managers that bought the product got an instruction to sell 3% of their portfolio. Now, do you see what happened?
Yeah.
Asians got 2%, Europeans got 3%. So now 3% is a bigger number, right? And so any asset manager in Europe that had this portfolio insurance got a message, you need to raise cash and you got to sell 3%, whatever it is. However you get there, you just need to raise, if you manage $1 billion, you need to raise 3% cash by the end of the day. However you get there, you can sell whatever you want. It didn't tell you specifically what stocks to sell. They just said you need to raise this cash. So you would sell names that you could sell, right? Names that were large, that were liquid. You wouldn't sell. Go ahead and try to sell an illiquid name. Good luck. So what ended up happening was the European market started to come under pressure. Now, 5 o'clock in the morning, I get out of bed, right? It's Monday morning now. I take a shower, I shave, I get dressed, I get in my car, I drive down to the train station. What do? I buy a cup of coffee and I pick up the what? The Wall Street Journal on Monday morning. What's the Wall Street Journal telling me? It's telling me what happened when? Friday. It's not telling me what happened on Monday. Right? Because it's only Monday morning here, but yet Monday's already passed in Asia and half the day Monday's already gone in Europe. But I'm reading about what happened on Friday in the markets. I have no clue that the world is starting to become unglued, right? No clue at all. There was no telephone. No one was calling me up, sending me a message going, oh my God. So I get to work. I take the train to Grand Central. I take the subway down to Wall Street. I get off. I go into my booth and on the floor of the New York Stock Exchange. I get there 7 o'clock in the morning. And I'm starting to organize my tickets from Friday because there were a lot of tickets because the market had been busy. And I'm doing what I typically would do. And suddenly the phone rings. Well, dude, when the phone rings at 7 o'clock in the morning on the floor of the exchange, either somebody's dead because the phone doesn't ring at 7 o'clock in the morning, or there's something happening, right?
Right.
So the phone rang, and it was a buddy of mine from First Boston who was also a client who calls me up and he said to me, bro, do you have any idea what's happening? Now, I had no idea what he was talking about. I'm going, I'm not sure what you mean, but not really. What's happening? Did somebody get killed? The president get killed? I don't know what happened. He said, dude, it's going to be a bloodbath today. Now, this story that I'm telling you, if you go to YouTube and you Google it, somebody made a cartoon out of this. I told this story one day at an event, and somebody created a cartoon and got my voice telling the story, and you can find it on YouTube in a cartoon form. But yeah, it's very interesting. This guy said to me, "It's going to be a bloodbath." I go, "What do you mean it's going to be a bloodbath? What the fuck happened?" And he said, so he started to tell me what happened in Asia, what was happening in Europe, and now what the portfolio insurance guys did now that they saw Europe was coming unglued, because now the European markets came under tremendous pressure, is that they sent the message to the American institutional asset managers that bought this product: you need to sell 5% of your portfolio and raise the cash. So do you see what happened? 2% turns to 3%, turns to 5%, and it's cascading. Right. So he said to me, it's going to be a bloodbath today. Well, I didn't know what a bloodbath meant, right? I mean, I kind of knew what it meant, but I'd never experienced a bloodbath, right? And so as the clock ticked closer to 9 o'clock, suddenly there were all kinds of, the phones were ringing, people were entering orders well ahead of the normal time, right? Orders would start to be entered around 8:45, 9 o'clock. We were getting orders at 8 o'clock, 8:15, sell 100,000 IBM, sell 30,000 Johnson & Johnson, sell 200,000 General Electric. Orders like you would never have seen. They were all market orders, sell it at the market, because these institutions were selling. What were they selling? Think of the names I just said: Johnson & Johnson, American Telephone, General Electric. They were all
liquid?
Big, multi-cap, mega-cap U.S. names, right? Because they could sell them, or at least they thought they could sell them.
Right.
Now, here's the problem. When everybody gets a sell message, nobody's getting a buy message. So everybody becomes a seller. This is where I would say it was very interesting, because it was all about human behavior. And it was like the human beings took the brains out of their head and just put the brain over here, and they just did what the computer told them to do without regard. So what I mean by that is, think about this. Johnson & Johnson closed at $96 on Friday, October 16th. You know where it closed on Monday night, October 19th?
No, I don't. When?
$45. It lost 50% of its value in one day. In 6 hours, it lost 50% of its value. So here's what I mean about the stupidity in it. Because, and trust me, it was one of the names I was in that day. And yet you'd walk into Johnson & Johnson, and there'd be 10 brokers trying to sell Johnson & Johnson. There were no bids. And so the specialists would widen the market. And he'd make it a 5-point market. He'd say, okay, who wants to sell this down 5 points? Because that's where you're going to sell it. And you're not even going to sell it all. I got 100,000 Johnson & Johnson to sell. Down 5 points. I might be lucky if I sold 10 grand, because everybody's got to sell stock, right? And there's not a bid there. And so the specialists, because those specialist systems at the time, and they were widening the markets because they were trying to control the mania, right? At some point, someone's going to say, okay, this is dumb. Let's not do this. But you called me up as a client. You gave me 100,000 Johnson & Johnson. And I came back to you and I said, listen, Rich, there's 5 sellers. There's at least 500,000 for sale outside of you, and there are no bids. This thing is going to trade down $5 or $8. Are you sure you want me to make that sale? Because you're only going to sell 10 grand, down $5. And you would scream at me, do what I preach. Hey, sell the stock. This is what everybody was saying. Why? Because the computer program said you have to sell the stock. Because remember, here's where we get into the algorithms. There's no emotion in algorithm. All the algorithm knows is, I got to raise X amount of cash. Do it however you have to do it. If you got to sell down $10, they sell down, because the computer doesn't recognize the emotion of it and the depth of it. All it knows is, I got to raise cash, and this is how you do it, right? And so the computer program in this portfolio insurance kept sending the message, sell, sell, sell. And so the human beings, what did they were like, it was like a herd of sheep. They just followed each other. And so it was an incredible day when I think about it. To be there at that moment, it was because it was IBM, it was American Telephone, it was GE, it was all the stocks that you know, right? I mean, you go try to sell 10,000 shares of Bank of Hawaii. Bank of Hawaii would trade 100,000 shares a day on a normal day. Try to sell Bank of Hawaii on a day like this. Forget it, you ain't selling it. So they didn't sell Bank of Hawaii. They sold the names they could sell. And they destroyed, like Johnson & Johnson, closed down 50%. Think about that. For 1 minute, it lost 50% of its value in 6.5 hours.
Yeah.
Right? But that was the bloodbath. And it happened everywhere. It happened JP Morgan and American Telephone and Coca-Cola and all, McDonald's, all these names.
The blue chips, yeah.
But absolutely destroyed. But it was because this product, right? Now, remember, out of that disaster then was born the circuit breakers and the ability to halt the market. Because I'll never forget that day. I went over to they called it the money desk. And it was a desk right on the floor of the exchange that had direct lines to all of the CEOs at all the major banks. It had a direct line to the Fed. It had a direct line to the White House. And what I'll never forget is seeing management at the New York Stock Exchange, on the phones trying to discuss, what do we do? Should we halt the markets? Do we stop? But the decision was made, if you stop trading, it would create more panic. would be like a run on the bank. Suddenly you shut the bank doors. You say, no, 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 you can't get your money. You would create panic. And so they made a conscious decision not to stop trading. And they just let the markets continue to unravel. And by the end of the day, the Dow was down 526 or 598 points, whatever it was down 22.5%. But the broader market was down 22.5%. But individual names were down even more. Johnson & Johnson down 50%, GE down 40%, JP Morgan down 30%, right? So it was amazing to think how, you know, in retrospect, how the human beings is, wait, stop.
Yeah.
Right? That like this is crazy. But nobody did. Nobody had the guts to do it, honestly, because the product was new. You paid for it. It was supposed to be 21st century, right? We were still in the 20th century, but it was supposed to be 21st century automation taking over. Well, it took over all right, and it created a complete disaster. But from an experience, you know, like I said, I was 26 years old. It was one of the most amazing days of my 40 years on the floor of the exchange. And then, you know, in the days and weeks afterwards, the markets remained really volatile because the next day the market shot up. Yeah. Right. And then the day after that, it shot down again. And the day after that, it shot up again. It was because it had suffered so much internal damage that it didn't know which way to go. Right. And so it remained very volatile for, I'd say, for a good 2 to 3 weeks after the fact. And then it started to settle in. But out of that event were born things like circuit breakers. So today that could never happen. It could never happen in the way it happened. So today the circuit breakers kick in at every 7%. Right. So if the S&P is down 7% from last night's close, they halt trading for half an hour. Then it reopens. It's allowed to drop another 7%. If it drops a second 7%, they halt again. Now, but everybody knows that, so it wouldn't be a surprise, right? So therefore, because you know that could happen, then it wouldn't be like panic. You know, okay, we're down 7%. We have to take a breath. Right. We got to assess the damage. We got to see what's going on, right? And then it would open the third time. And if it continued to spin out of control, they would just let it go to where it went. So could it potentially fall another 22% in one day? It could. Most likely would not, but it could, right? But the circuit breakers are in place to kind of slow it down and give everybody a chance to breathe, right? So that was 1987, and that was, you know, now the back of my shirt is soaking wet because the sweat is just running down my back. And then, you know, and then the 90s came along, right? 1987, then the markets calmed down, 88, 89. And then we got into the 90s, and it was this whole big tech boom, because what was going to happen a decade later was this thing called Y2K, which was the turn of the century. And again, it was, you weren't, what year were you born?
98.
Okay, so you were two. Okay, yeah. So
wasn't paying attention to too much.
No, you weren't paying attention. Yeah. But what happened during the 90s was this massive. Again, the markets were just so exciting and they were so dynamic, and anything tech was just crazy because we were heading into this Y2K event. And remember, the issue around Y2K was GPS systems and electric systems and water utilities, that they were going to cease to function on the turn of the century because we were going from hard coding in Microsoft. They used to, you know, the date was written in 2 decimal places. So it was 12/31/99. Today it's 12/31/1999, right? You have to actually write out the 4 decimal places in the year. But then it was only 2 decimal places. So we were going to go from 99 to 00. The computer didn't know if we were going forward or backwards. And so therefore it was projected that computer systems around the world were going to fail at the turn of the century. So, and it wasn't just a US problem, it was all over, right? It was because that's how the computers were coded. And so the 90s were an amazing time to be a tech investor because anything tech was just on fire. And the markets had regained its footing and the economy was strong again. And, you know, it was really, again, it was a really great time. The Clinton years were, great years. The Reagan years were great years. And so in terms of the market, right? And then and then what happened is we got into the late 90s, then the internet started to become much more popular. And then things like .com suddenly appeared. And then you had the .com debacle, right? That started in 1998, very much kind of like what we saw with NFTs or SPACs this year, that they became they took on lives of their own, right? Now, remember, anything with a .com on it back in 98, 99 did not trade at the New York Stock Exchange because they didn't meet the requirements to come listed at the New York Stock Exchange. So they all traded on NASDAQ because NASDAQ would take anybody, right? And they didn't, and there were, the truth is, at the New York Stock Exchange, there were rules and regulations. You had to be so big. You had to have so much stock outstanding. You had to have, you had to have a history of earnings and all that stuff. And so companies that didn't meet that criteria either went on the American, they started there and then they grew and then they would transfer, or they went to NASDAQ and they would start there, they would grow and then they would transfer. Right? Or they would not transfer. Apple started on NASDAQ and never left. Microsoft started on NASDAQ and never left. Could they come to the New York today? Of course they could. But they choose not to now because NASDAQ is the one that gave them their opportunity. NASDAQ's considered much more of a tech space, right? So they're staying there. That's fine. But so there was all that excitement building around Y2K and then .com. And then it was all about market modernization because technology had started to change the world so much that you had to incorporate new technology into the way the markets traded. And the only way you could do that was modernize the rule sets, modernize the markets, understand how the role technology was going to play. Were there going to be instant executions? Or was it going to be ordered delivery? Was it still going to be human-based? Was it not going to be human-based? Right. And so all those things came into question kind of in the early 90s, right up through the decade. And while I was at the New York Stock Exchange, I was involved in so many of those conversations at the New York Stock Exchange, how to design what is now the technology at the New York Stock Exchange, right? I was part of that committee. I mean, there were a lot of us, not just me, but there were a lot of us that were part of those committees to help create the technology that would ultimately begin to change the New York Stock Exchange. Anyway.
Yeah. No, that's fascinating. Yeah, go ahead.
Yeah, but we went through the turn of the century. The world did not collapse. Now, you have to understand this, is that Europe and Asia had converted their markets to automation and decimalization in the late 80s and early 90s. We were still trading face-to-face, pen to paper, eighths of a dollar through the turn of the century because in the event that there was this massive technological collapse, the European markets and the Asian markets would have been screwed because the technology would have failed and you wouldn't have been able to trade. In the US, we were still trading pen to paper, face to face. And so in the event that there was a problem, the US markets couldn't still function, right? We made a conscious decision in this country that we were going to trade that way through the turn of the century. All the while, in the back room, they were making plans to start with the automation, but the automation would happen post the turn of the century, right? So that takes you up through the turn of the century. Now, I could go into the new century if you want. And talk
no, that's perfect. That's
listen,
perfect.
The role that, well, we'll get there anyway. The role that 9/11 then played, because that was the next major event that was going to affect the way that not only markets traded, but the way that we then use technology.
Yeah, and I think you've got an excellent video on your YouTube channel talking about just that. So yeah, definitely, I would point people to that. I wanna know, because given your experience as a floor trader, what did that kind of teach you about reading the tape and reading market behavior, and how does that inform right now currently how you interpret the markets as well as manage money as well?
Yeah. So when you were on the floor, you had to learn how to read the tape. You had to be able to look at the tape and get a sense of what was happening broadly in the market. Even though you might have been in Coca-Cola, but you wanted to know what was happening in the other sectors, what was happening in healthcare, what was happening in utility stocks, what was happening in industrial names. And so you had to be able to read the tape. You had to remember, you had to know stocks and sectors. You had to remember prices. Were they trading up? Were they trading down? So reading the tape was a skill that you had to learn. You can't learn how to read the tape in college. There's no course that's going to teach you how to read the tape. You learned how to read the tape by being there and feeling it. And part of feeling it was all the noise in the room as well. The voices of the brokers. Were they excited? Were they muted? Were they right? Were they when the market was trading up, it was one noise. When the market came under pressure, when it was trading lower, it was a different noise. And you had to feel that noise. You had to feel it, right? And you had to feel it, and you had to be able to sense the difference between, an up sound versus the down sound, right? Besides the fact that you could see the prices on the tape, were they trading up or were they trading down? And so that skill was something that took time. You didn't just learn it overnight. It was a sense of it was like the way you learn anything, right? You learn a language, learn how to play an instrument, learn how to play a sport. It takes time to learn the rules and the intonation and the nuances of the different sounds, right? Today, what's interesting is it's much more difficult today because those sounds don't exist anymore, because there's no people, there's no roar, there's nothing. If you go on the floor of the exchange today, yeah, at 9:30 there's all this noise because people are clapping and all that shit. But at 9:45 everybody's gone.
Yeah.
And so it's quiet. You don't hear that roar anymore. The computers don't make any sounds. There's no roar when the buyers are coming in, or any different sound when the sellers are coming in. It's just sound, right? It's like white noise. So it's much more difficult today. Besides the fact is that the market's much more fragmented today. The New York Stock Exchange is now not the only exchange. There are now 10 exchanges that exist. The New York Stock Exchange is the only physical exchange. The other 9 exchanges that exist are in the cloud, right? They're like NASDAQ. They're just an automated exchange. Now, I say that because the New York Stock Exchange is automated, yet there's a physical location. There are people on the floor that actually run those computers that do it. In the other exchanges, it's not. They're in big warehouse rooms, and the computers run themselves. And there are people there that maintain the computer, but they're not interacting with it. They're not putting buy interest in or sell interest in or managing order flow like that. That happens only at the New York Stock Exchange.
Right.
But because of the events of 9/11, that then created this fragmentation. And I think that's important for people to understand, because prior to 9/11, there were really 2 exchanges, right? There was a New York and there was NASDAQ. And stocks that traded on New York traded on New York, and stocks that traded on NASDAQ traded on NASDAQ. You could not buy Apple on the New York Stock Exchange, and you couldn't buy GE on NASDAQ, right? And so there was a demarcation. And what 9/11 exposed was the weakness in that, right? And the weakness in the fact that here we were, the biggest capital market in the developed world, and we were still trading in a single location in Lower Manhattan with the same 5,500 people every day that made that building run. And when 9/11 happened, and it didn't, those planes didn't hit the exchange, they hit the trade centers, as you know, but the trade centers were 3 blocks away from the exchange. And so when it happened and the towers collapsed, what people don't realize, and it wasn't advertised this way then, was the New York Stock Exchange had become, by 2001, had become fairly automated, right? In terms of order delivery, execution, all that stuff. People were starting to get weeded out in place of technology. But all the cable lines and the fiber optic cables and the T1 lines and all that shit that ran all those servers at the New York Stock Exchange all ran through the belly of the trade center, right? And I say that because there was a conduit that went out through the belly of the trade center, underneath the Hudson River, and then out, when it got to Jersey, then it went out to the rest of the country to connect the rest of the country into the New York Stock Exchange. And when 9/11 happened and those buildings collapsed, all those conduits got destroyed and the lines got severed. And so the New York Stock Exchange now couldn't run. Yeah, you could turn the electricity on, you could turn the lights on, you could even turn the computers on, but the computers weren't working because there was no data coming in.
Right.
The connections were cut. There was nothing, right? And so what people didn't realize was that had happened. We know it happened, but the country didn't know it happened, because it would have created panic. Because here you are on Monday, and you're someone who's worked your whole life, and you've got a portfolio that's worth $5 million. And Tuesday happens. Now this event happens. And now you call up your broker and you say, listen, I want to sell my stocks because I'm nervous. I want my cash. I don't want to own Boeing and GE anymore. I want my stock. I want my cash. So sell all my stocks. And so your broker said to you, I can't sell your stocks because the New York Stock Exchange is not open. Okay, we'll wait till tomorrow. Tomorrow came, you call up, sell all my stocks. I can't. The New York Stock Exchange is not open. Now, we weren't open because we couldn't open, right? Nothing worked. And it became apparent to us right away that had happened. And so we shipped in guys from all over the country almost immediately. Phone guys, cable guys, tech guys. They had to rewire the New York Stock Exchange, every single server, and trust me, there's a lot there.
Yeah.
They rewired it all back out to the country. But the other thing they had to do was all those brokers whose offices were destroyed in the trade centers, all those brokers had to be relocated. You couldn't open up the market and say to Merrill Lynch, "Oh, I'm sorry, I know your office got destroyed, but we're opening up anyway with or without you." You couldn't do that because you're disadvantaging all Merrill Lynch clients. You couldn't do that. And so before the markets could open, they had to get all these brokers set up somewhere. And so at the time, it was the meatpacking district, which today is a very vibrant place, but then it wasn't. It was kind of a place in transition. And so there were all these massive warehouses that were empty. And so the city immediately opened up all these massive warehouses, and people like Verizon and Bloomberg delivered equipment, phones and Bloomberg machines and picnic tables. I mean, it wasn't the big fancy office you lost. It was, when I tell you picnic tables, it was picnic tables with Bloomberg machines and phones on it, right? But when you think about it, that event happened on Tuesday, the 11th, and on the following Monday, which was the 17th, so it was 6 days. 6 days, we got the place up and running again. Now, it was put together with spit and Band-Aids, trust me. It was not a very solid response, but it was what we could do, right? Because there was no backup plan. Who would have thought that event could have even happened? Who in their right mind could have prepared for that event? And so there was no backup plan, which today, by the way, there's 10 backup plans today, right? As there has to be. That event what that event did was expose the weakness, right? Really, not only in this country, but around the world. Weakness that other countries had too in terms of their bankings, financial systems, and all that stuff. Anyway, so as a result of that event, we have now the 10 exchanges, right? They're all fragmented. They all trade. They're all interconnected. But this way, if one of them goes down, the country's not held captive like it was in 9/11. So during COVID, whether any of your listeners realize this or not, do you realize for 7 weeks, the New York Stock Exchange didn't open during COVID? They shut the New York Stock Exchange down from March till June of 2020, right? But if you were a stock investor and you were buying and selling stocks, you had no idea that had happened. Why? Because the other 9 exchanges, which operate in the cloud, operated just fine, right? In 9/11, in 2001, none of that existed, so you couldn't, right? And so today, if they blow up the New York Stock Exchange, is it a tragedy? Of course it's a tragedy. And I'd like to think maybe the markets would close for a day, but the next day, the markets in this country would open. Now, they might get ugly, stocks might sell off, but yet you as an investor would have an opportunity to make a decision, sell or buy or do nothing, right? But that's a direct result of what happened after the events of 9/11. And that then laid the groundwork for the changes and the automation and the way we use the automation today. Because prior to 9/11, the automation was all about efficiency. How fast can we do it? Post 9/11, it's now about security and stability first and second, and then efficiency comes third, right? Doesn't make a difference how fast you can do it if you can't do it at all, right? So you got to be stable and secure first, and then you can be efficient. And so that dynamic, that event changed the whole dynamic of the way the markets operated, the way the country answered that event, right? How we answered that event. But so the lessons I learned, the being able to read the tape, being able to feel it in your gut, those are all things that I learned during a time when you could actually feel it.
Yeah.
Today, it's much more difficult because it's so fragmented, and because you might sit in your office, you might sit in an office all day with one other person, and there's no excitement around you, there's no noise, there's no conversation, and so it's much more difficult today to learn how to read the tape, and it's much more difficult to feel the market, because when you see prices just tick across your computer screen, you can't hear it, you can't hear the roar, you can't feel anything. So I actually, for me, I can still read the tape because I was taught how to read the tape. I mean, I would imagine today it's much more difficult to get that feel because there's no physical feel anymore, right? You just have to be aware of what's happening around you. You have to really know what's happening in the sectors, what's happening in individual names, and how quick the algorithms and the computers can change the tone of the market on a dime, on any day. Right.
Yeah. And I want to pivot just a little bit and kind of lean on your experience a little bit. When a company comes out with a game-changing earnings report where they announce a new product, or earnings year over year up 300%. They surprise expectations by 100%. How do institutions then come in and place orders to accumulate the stock? And how does that continue over the next few weeks and months as they try to build up their positions because of that change in perception of the company? They're changing their models.
Right.
How does that whole process kind of come together?
Right. Well, today it happens very differently than the way it used to happen.
Right.
Right. Because it used to happen by coming to the floor of the exchange where the stock's traded, and then everyone would be representing themselves. If it was Johnson & Johnson or Merck or Coke, anyone that wanted to buy or sell it at that moment in time was represented. Today, when Coke or Merck or Johnson & Johnson or any other company comes out and announces some blockbuster event, because it's so fragmented and automated, how does it happen? It happens where Goldman might say, I've got, I don't know, maybe it's the New York State Teachers Pension Fund, right? And they want to now buy. They already own Johnson & Johnson, and now Johnson & Johnson came out with this new blockbuster announcement, some drug, whatever. They want to build up their portfolio, so they call up Goldman Sachs and they say, I need to buy 5 million shares of Johnson & Johnson. But so is every other asset manager out there trying to buy Johnson & Johnson based on the news. So how do they do it? You've got to do it electronically because there's no more human being to do it. There's no more place to go to get a central market, to get a sense of where the stock is trading. And so what you have to do is depend on the technology. And because now there are 10 exchanges, plus there are 40 or 50 alternative venues, which are called those dark pools, if your audience knows what a dark pool is. And dark pools were also things that were born out of 9/11. They were being born just prior to, but then when 9/11 happened, they just exploded, right? But today there are all those different venues, the 10 exchanges plus the 40 or 50 different dark venues. And so what do? All they do is use their technology and they spray the system. They spray their orders out looking for sellers wherever it is. But everyone's doing the same thing, right? And the algorithms now know that. Here's really the dirty secret of that. The algorithms, the algorithm, once you put an order into a system, into an algorithm, the algorithm knows all the demand that's there, right? Because it can see all the buy orders. At the same time, then it can see where the sell orders are, or it sends a signal, which is why then sometimes you see these gap up in prices because the sell side cancels, because the algorithms have alerted the sell side that there's all this buy interest, and so the sell side cancels and moves their offers up, and now there's a void, and then you see these dramatic moves higher. And you see it happens, and the same, by the way, works on the way down. There's negative news in a stock, and suddenly there's all these sellers, and so the algorithms notify the buy side, and so the buyers draw their bids, and now there's this void, and prices collapse, and it happens very quickly, right? And so how do they do it? They try to do it strategically. They try to do it without creating panic. But in the end, you see it every day when stuff like that happens. You see, look what they did to CrowdStrike a week ago. They took 25% out of the stock last Friday because the CEO came out. They hit their number. They hit their earnings number. I think they missed by a penny. Okay, great. But all he said was he was cautious over 2023. Every one of them saying that.
Yep.
Right. But CrowdStrike is in the cybersecurity space. Cybersecurity, if anything, ain't going away. Right. And I'm still shocked even today why cybersecurity sector is down 32% year to date. That makes no sense to me. And CrowdStrike being down 48%, and they're the key player in the space, makes zero sense to me. But when he came out and he made the comments, he's cautious on 2023 and clients are pulling back and they're not spending so much on cybersecurity, which I think, first of all, bullshit. If anything, they're going to spend more money on cybersecurity because they've got to maintain system integrity, right? But one way or the other, he says it's cautious. They took 25% out of CrowdStrike before you could even blink your eyes. But that's how fast it happens. Now, conversely, it's the other way around too. CrowdStrike comes out with this great report. Oh, and by the way, it's so bullish on the next year. They're gonna take it up 25% before you can blink your eyes. Yeah. But that's what I'm saying. That's the stuff that would never have happened that fast, that way, back when there were human beings on the floor. And by the way, we traded in eighths of a dollar because the eighth of a dollar was 12.5 cents. And so before you reached up and paid up 25 cents or 37.5 cents, you better know damn well what you're doing. Today in a sub-decimalized environment, because today we trade in decimals on the listed exchanges, we trade in sub-decimals and all those other dark venues. So there's really 1,000 price points between $20 and $21 because it's $20 and then it's 20 spot 0001, 00,
Yeah.
all the way up to 9999. That's 1,000 price points. And so therefore the technology is what allows that to happen, right? And so everyone's bidding and offering at different price points, sub-decimals, and all these different venues. And so everyone's searching for the supply in this case, if it's positive order, or they're searching for the demand if it's a negative order, right?
Right.
But it happens so much differently today than it did when I was your age on the floor of the exchange, right? And so, I could talk about how it happened then, but that's irrelevant now. It doesn't make a difference how it happened then. I can tell you because I can tell you a story, but it's irrelevant to what happens
current
today.
markets.
Yeah, to the current markets. And I'm not trying to put it down, but it's the truth, right? Sure, you want to be entertained, I can tell you then, but it's not going to help you today. All you have to do today is be very aware of, I would imagine, very aware of the news, what the news really means. You got to be much more aware of technicals on the chart. Where are you expecting to find some resistance? If suddenly all the sellers withdraw, and there's avoiding prices, where is it really going to go? Like where you have to be able to identify, okay, where is the next stop? Where would they have gone to? How far up is that? Does it make sense? Right? That's how you have to trade it today. But the way they do it today is completely automated. There's no human being. There's no human being.
That makes perfect sense. Yeah.
And listen, places like Goldman Sachs and JP Morgan and Bank of America Merrill Lynch, they've all got their technology on all the buy-side desks, right? And so you don't even have to call the guy at Goldman Sachs anymore. All you have to do is click on the Goldman Sachs icon, their trading icon, and an order ticket pops up. You, as the portfolio manager, enter an order. Buy 1 million shares of Johnson & Johnson. You want to spread it out over the 6.5 hours. You want to be a percentage of the volume. You put all these parameters on it, and then you hit the button and you let it go. That was never the way it happened when I was your age in 1980 and 1990. Not the way it happened. But today, that is the way it happens. And because we trade in sub-decimals, does it really make a difference if you bought the stock at the end of the day, if you bought the stock at 50 spot 1234 or 50 spot 1289? Doesn't really make a difference in the long term. If you're a long-term asset manager, doesn't make a difference. You're not going to buy the stock to sell it tomorrow. You're buying the stock because you're going to hold it for 3, 4, 5, 6 years. So in that sense, they've desensitized the execution, right? But I guess that's the role that technology plays, right? It changes everything dramatically. In whatever industry you're in, technology changes it dramatically.
Yeah. And I'd also love to hear your thoughts on kind of, the current markets and kind of what the Fed is doing as well. We're recording this on the Thursday, so we'll probably post this weekend. But, really since last fall, many stocks, have declined considerably. We're in a longer term bear market. We're pushing up a little bit, but there's still some volatility, of course. How are you kind of personally handling things, and what are your personal views about what's going on?
So my personal views is it's a shit show, because look, the truth is, and people forget this, they think, this has only been since COVID. You realize we've had 0 interest rates and we've been buying bonds since when? 2009, during the height of the great financial crisis. So we've actually been stimulating this economy and this market for 13 years. This isn't just a COVID thing. This didn't start in 2020. They've been doing this since, and it's not just the Fed, it's the ECB, the Bank of England, the Bank of Japan, People's Bank of China. Every central bank around the world has been doing this, and they've been doing it for 13 years. So let's just get this straight. We're kind of in uncharted territory. There's no history to guide us. Okay, how's this going to end? No one really knows, because we've never been here before. We've got a Fed balance sheet that's topping, nearly $9 trillion that the Fed has now got to work its way out of. In addition, we've got inflation out of control. And while I don't think it's going back to the 1980s in terms of the actual rates, with a 13% inflation rate and a 20% Fed fund rate, but remember, 1980, interest rates started out at 6% and went from 6 to 20. We started out at 0, so going from 0 to 10 would be the same as going from 6 to 20, essentially, right? So what I'm afraid of is that we are in uncharted territory. We don't know necessarily how this is going to react as they start to tighten and continue to raise rates, and if inflation doesn't respond. Now, tomorrow's going to be we're going to get PPI on Friday, and we're going to get CPI next Tuesday, which are going to be 2 inflation readings, and they're both supposed to be lower. And I hope they are. right? I hope they are, because then that will mean that part of what the Fed has done is in fact succeeding. Doesn't mean that it's all over yet, though, because they really haven't started to tighten yet, right? Once they start to really take liquidity out of the system, that's going to also amplify the move of higher interest rates. So I think that the market is in for still some tough time. Now, you and I are having this conversation. You're 24, I'm 61. So my thought and idea of how I'm going to set my portfolio is going to be very different than how you trade, because you're 24. You've got 50 years ahead of you.
Yeah.
I don't have 50 years anymore. I'll be lucky if I got 20, right? And so my perspective has now changed. But if I were your age, I would be putting all my money in. I would go way out in the risk scale. I'd look at some of these names that have gotten really beaten up, but are good, solid names. I'm not telling you to go out and buy, Peloton or even Zoom, by the way. I would tell you to go out and buy, more Apple, more Amazon. I'd tell you to go out and buy CrowdStrike. I'd tell you to go out and buy Palo Alto Networks, right? I'd tell you to go out and buy artificial intelligence names, right? Now, I own Apple, I own Amazon, I own Microsoft, I own IBM. But at this point, and I own CrowdStrike. But I'm not going to buy Zoom, and I'm not going to buy Peloton. I'm not going to buy Teladoc. I'm not going to buy Carvan or Carvana, whatever it's called. I never bought those names anyway, right?
Yeah.
And I'm certainly not going to buy them now. So my portfolio, and I've been talking about this for a year, if you go back and look at my musings and my writings and all that stuff, is that I started talking about this time last year, that 2022 was going to be a difficult year, and people should set their portfolios up to be big, boring, and beautiful. Now, that could be you too, temporarily. But by big, boring, and beautiful, what do I mean? I mean big mega cap names, multinationals, that are good dividend payers. Yeah, they're boring. Johnson & Johnson. It's a boring name. It's not Tesla. That's right, it isn't. Tesla's exciting, but look what it is. Tesla's down 70% or 60%, whatever it's down, right? Johnson & Johnson might be down, what, 8%, 7% in a year? So it's a big, boring name. It's a good dividend payer, but it offers shelter in the storm, right? If you look at, and so that's how I have been telling my clients and myself how to prepare in this year, right? So I call it stuff that people need, right? STPN. So you need healthcare, you need energy, you need utilities, and you need consumer staples, right? So consumer staples, think Procter & Gamble, think Kellogg's, think Walmart, right? Healthcare. Everyone needs healthcare, whether there's a recession or not. You need healthcare. So UNH, Cigna, CVS, Aetna, right? All right? You need utilities because you need to turn the electricity on in your house, right? So it's Con Ed, it's energy, it's whatever. And by the way, utility stocks are good. They pay 4 and 5% sometimes in the dividend yield, right? And by the way, in the middle of all this, while the Nasdaq's down 30% and the S&P's down 18%, utilities are actually up 1%. And they paid you 4 or 5% in dividends, right? So there's safety in utilities. If you own utilities, you wouldn't be moaning and bitching right now because your portfolio would not have gotten slaughtered, right? If you look at healthcare right now, healthcare's down, it's off less than 1%, healthcare, right? The industrials are down 5%. So when you think of Caterpillar Tractor and John Deere, those are big industrial names, right? They're big mega cap multinational names. They're good dividend payers. And when the economy turns around, you want to be in the places where the industrials are going to be able to take advantage. But I have not sold my tech. So I haven't sold my Apple. I haven't sold my NVIDIA. I haven't sold my CrowdStrike. But new money that I'm putting to work, I'm putting to work in the STPN crowd. So therefore, my holdings in tech, I haven't changed them, but they're a lesser percentage of my total portfolio because new money has been allocated to these other sectors. And so just by definition, their percentage of my portfolio has gone down. I didn't sell them. They're just a smaller percentage of the portfolio, right? So that's how I've protected, and I'm going to continue to protect because I think 2023, at least the first 6 months, are going to be a continued volatile time, right? I think that the markets are going to continue to be under pressure. I think that the Fed is going to find that inflation is not responding as quickly. Look, they got a 2% target on inflation. We're still at 7.7%, right? We've had 6 significant rate increases. Inflation made a high of 9.1%, I think, this year, right? It's now at 7.7. Okay, it's come down 1.4%. We've had 6 significant rate increases, and it's only brought it down 1.4%. We still have to go down 5 percentage points to get to 2%. Right. So what I think is going to happen, the Fed's going to find it difficult to do that. So I think in probably by the end of the first quarter into the second quarter, the narrative out of the Fed is going to change. Now the target's going to move to 3 or 4%. Mm-hmm. That they're going to be willing to say we can have 3 or 4% inflation. Because now if they move the target up, now the 7% inflation, now we're only 3 percentage points away. Right now we're 5, but if they move the target up, now they've closed the gap a little bit. So they've made their job potential a little bit easier. And then if they get it down to 4%, then they can maybe once again talk about taking the target lower again. But I think until that happens, I think the narrative is going to change in 2023. And that's how they're going to try to work through it. But I think that then is going to cause more volatility in the markets, right? Which doesn't mean you should light your hair and run out the door. It just means you need to understand that and then prepare yourself accordingly. But look, again, you're 24 years old. So whether or not you have 10,000 or 150,000 makes no difference. You, as a young man, and anyone kind of in your age group, you should be further out on the risk scale. Yeah, should you own some of those big names that I just told you about? Of course you should, because I think some of those names are foundational in any portfolio, whether you're 24 or 64. I think Apple's a foundational name. I think IBM, Johnson & Johnson. I think those are names that you should own and just own. Microsoft, just own it, right? But you're going to design your portfolio maybe with further out on the risk scale with names that maybe I'm not going to buy. But the only reason I'm not going to buy them is because I don't have the time or the tolerance for that much risk anymore. I did when I was your age, but I don't, at the moment I don't now, right? You should not even have, at your age, you shouldn't have a bond or fixed income anywhere near or in your portfolio. You just shouldn't. Now, maybe you should if you're really worried about where the market's going. You can go out and buy a 2-year treasury and get 4.2%. guaranteed with no risk. Okay, if you're really that concerned and you're worried about the market selling off, yeah, then put your money in treasuries. It would be like going to the bank and putting your money in a CD, which, by the way, you can do and get 4.5% today, is what I heard. So that is going to start to challenge some money, especially people that are unsure about the markets. They don't know them. They don't feel comfortable with them. They don't want to lose money. So they're going to take their money and go away until it calms down. But I would say, for you and for people, anyone less than 50, you should certainly be further out in the risk because you have the time on your side. Even a 40-year-old has 40 years to go. Right? 80. If you're 40, okay, you got 40 years to go. I'm 60. Do I have 20 years? Do I have 25 years? Yeah, probably. Do I have 40? Most likely not. Right? And so therefore, that's why, my portfolio is going to look different than yours. But anyone in my age category is going to be reflective of that kind of a portfolio. Much more conservative. Bonds are not a big part of my portfolio, although they might be if I get more concerned and I can put some money away for 2 years and get 4.5%. That'll help balance out the risk that I have left in my portfolio. Maybe that is a place I'll go. But you shouldn't go there unless you completely panic and say, "Oh my God," right? But you don't look like the kind of guy that's going to panic.
No, you usually got a plan.
Yep. Yeah. You look like the kind of guy that's got your head screwed on straight, and you're gonna be in it. Here's the other thing that I don't do, and I never did, partly because I couldn't do it when I was on the floor of the exchange. I couldn't day trade. When I worked on the floor of the exchange, I couldn't have a personal trading account because I had access to information that other people didn't have. If I got an order from Salomon Brothers to go out and buy 500,000 shares of IBM, that was basically inside information.
Yeah.
So I could not have a personal trading account for fear that, wow, I know I got 500,000 IBM to buy. I'm going to go out and buy 10,000 shares from my personal account in front of the stock that I know I have to buy. So therefore, I couldn't do it. Legally, I was bound to not do it. So therefore, today, I don't day trade. I don't buy something and sell it 10 minutes from now or a day from now. My portfolio and my style has always been the long term. What am I looking at? What am I identifying? I'm looking at charts. I'm looking at places of support. If I made some mistakes, certainly, you're always going to make a mistake. Look, I love NVIDIA. I rode NVIDIA the whole way up, and guess what? I rode it the whole way down. I didn't sell any of it, right? In retrospect, should I have? Of course, I should have in retrospect. Should I have sold stock up at 275? Of course. It's trading at 160 today. But I've now taken this when it traded down to 124 2 weeks ago. I bought more down there, right? So I'm bringing my average down. I still like the name. It's a semi. It's in everything we use. Everything we use has a semi chip in it, right? And so therefore, that's another thing that I don't really understand why it's under so much pressure. Like there's a disconnect there for me. So, which is why I never sold it, because I'm thinking, wait, this is a semiconductor. Why is this happening? It didn't make any sense to me. But what do the other did? It happened, and I wrote it down. It's fine. I'm not crying about it because I'm still adding to my position. I'm good with it, right? But that's how I view. And like I said, I'm concerned about what the next 6 or 8 months has in front of us, right? Because I said, we've never been here before. There's no guide in history to tell us what's going to happen. And so everyone's flying by the seat of their pants, right? Now, look, if you noticed, 2 weeks ago, no one in the administration wanted to use the word recession. Wasn't happening. Nope, not happening. Inflation's not a problem. Now that the election is over, and now it's completely over because Georgia elected Raphael Warnock, so now it's all put to bed. Now, Joe Biden came out yesterday and said inflation's a problem and we're going to have a recession. 2 weeks ago, he didn't say that because the election was right up his ass, right? But now that it's over, there's no more election for another 2 years. So now we can say it. And now they're all saying it, right? So now what we need is for the NBER, right? The National Board of Economic Research, to actually come out and call it. Yeah, okay, we're in a recession. They should call it, because once they call it and it's actually out there and it's official, then I think you're going to get the market to be able to start to be a little clearer. Right now, there's still confusion. Is there? There isn't. Some people think there is. Some people think there isn't. The government says there isn't. But once they call it, then you know you're much closer to the bottom. Now, it may churn a while down at the bottom. Doesn't mean it's going to take right off again and rally back to 4,800. That's probably not going to happen. But what it will do is it will put clarity around the economy, and that will allow the markets and investors to get a little bit more comfortable, right? So I'm also not in the camp. Goldman and Morgan Stanley think we got a 20% drop from here. From here, they still think we got 20% to go. I'm not in that camp. I think the lows of the fall, like 3,600-ish, is kind of low. And I'm not surprised if we go back and test it. I fully expect we're going to go back and test it. We may not test it by the end of this year, but I think we'll test it early next year. Because look, we got this week is really the last. Next week is the last hurrah, because you got the Fed on Wednesday, you got the ECB on Thursday, you got the Bank of England on Thursday. After that, you got 2 weeks left in December. Everything shuts down. So there's no more stuff going on. And so after next week, it's kind of running on its own, right? But I think once the new year starts and now everyone wipes the slate clean, you mark your books to the December 31st, and come January 1st, it's a new year. So it's new performance. And just like it was in January of 2022, when the market started up and then boom, it got smashed, right? My sense is that we could see kind of a repeat in 2023 as we start to now get through further into these rate hikes, right? And a lot of it's going to depend on, look, we're getting 50 in December, we're going to get 50 in January, and we're going to get 25 in March, and that's going to bring us to 475, 5.25 on the terminal rate, right where they said it was going to be. But don't be fooled. 2 weeks ago, when Jimmy Bullard, St. Louis Fed President Jimmy Bullard, came out and dropped the bomb and said, and he said it very clearly, he said it, that the terminal rate could be anywhere between 5 and 7%. Now, he said that very much for a reason. They put it out now. Now it's in the public square. Now he said it. A Fed official who's a voting member put it out there in the public square. Now, up until this point, we were conditioned to think it was going to be 4 3/4, 5. But Jimmy Bullard came out and said very clearly, and Neil Kashkari is the first one who said it was going to go 5, 5.25, and then Bullard came out, it could be 5 to 7. Now, do we want to see it go to 7? Absolutely not. But if inflation doesn't respond the way they think it's going to respond, and the Fed is forced to go higher, they can turn around and they could say, well, what are you surprised about? Jimmy Bullard said it in December that this was the new range. They can point to it. They sent Jimmy Bullard out to float that balloon, right? And remember the day he said it, the market sold off, because the market, that was new news. But now it's out there. So people have discussed it. It's in the public square. The market's kind of, do we really want to go there? No, but if inflation doesn't respond, we could go there because I already said we could go there.
Mm-hmm.
You know what I mean?
Mm-hmm.
So that's what I'm concerned about kind of going forward, that in fact, that they're going to end up going higher than 5.25. I think that the terminal rate's going to get closer to 6. I think mortgage rates are going to have an 8 handle on them. And I think the housing market's going to continue to come under pressure, which makes perfect sense. But I think then NASDAQ names and the high growth names, the sexy names, are going to come under pressure as well, right? But in that chaos, there is ultimately going to be opportunity. I mean, you look at some of these names, when the market turns, communication stocks, which are down 36% as of tonight, those are going to be huge opportunities, but not yet. Yeah, you could start to nibble away at those now, but it might be dead money for 6 or 8 months. But who knows? Then if the market turns, those are going to be the first ones that everyone's going to go after, are all these names that are so beaten up. So you have to decide, do you have the guts to kind of put the money to work now and kind of let it sit there and wait? Or do you want to wait until you actually get the turn and then jump in?
Yeah.
Right? Because look, communication stocks are down 36%. They're not going to go from down 36 to up 36 in one day. They're not. You'll have an opportunity, but you should know well, anybody should know that those names that have gotten so beaten up, and the industries are in, it's communications, it's tech, it's consumer discretionary. Those are down, in their 20s and 30s. Financials are down 11. They've rebounded. Industrials are only down 5. Like I said, healthcare is up on the year. Utilities are up on the year, basically, right? They're flat. So in my opinion, they're up because you've gotten the dividends, right? Basic materials will also turn. Right now, basic materials, I think they're down 22% on the year. Semis are down 32%. Those are going to turn. Cybersecurity down 38%. That's going to turn. Mm-hmm. So I am, like, in semis and cybersecurity, while those sectors are down big, they are sectors that I'm starting to nibble away at because I want to be in there for a little bit. It's not a ton of money, but I'm starting to just pick away slowly and surely, right? Mm-hmm. Because I want to be there ahead of when the crowd comes rushing in. And then I want to ride the wave the whole way up, right? I don't want to be one of those guys that waits till everyone else is doing it. I want to do it before. So I'm starting to do it. I'm not overweighting those sectors yet because it could still be a while. Listen, when the Fed forced rates higher in 1981 and 82, the country went into a really bad recession for 2 years. Now, they haven't called this recession yet, but we've already been fighting. Remember, we're in December now. It was January of last year that they started to raise rates. So it's been a year that they've been raising rates already, right? And it's been since the second quarter, when we had the first and second quarter, both negative GDP, which was really the signal of a recession, but nobody wanted to admit it because we were in an election year. So you could say, and I think we've already been in a recession for a good 8 months already, right? If the NBER calls it in March of next year, okay, they'll say, okay, now it's official. Okay, well, when do you start measuring it? Do you start measuring it from March, or do you really start measuring it from February of 22, right? And so that's when I think you're going to see kind of the market start to stabilize and move higher. But if they continue to push rates, if rates normalize somewhere, Fed funds rates normalize somewhere in the 6 to 7% range, it's going to be a challenge for some of the sexy high growth names, right? Which is why I'm still in that stuff that people need category. And I would say to you, even though you're 24 years old, you should consider putting that stuff in there as well, because again, those are foundational holdings. Those are names that you could have and pass on to your kids, and then who knows if you have grandchildren. Maybe you will, maybe you won't. I don't know. You know what I mean?
Yeah, perfect. It should be interesting. Whatever happens. So.
Yeah, whatever happens, it's going to be what it is, right? And you can only do your best to try to manage that risk.
Right. And calling back to briefly, because I know we're getting to the end of it here. You mentioned how you do look at charts and use that in your analysis. I'd love to hear, as a kind of more longer term minded investor with that longer term time frame, how do you incorporate weekly or monthly charts? Because I'm sure there's a lot of people out there who work full time and aren't able to swing trade, position trade even. So how do you personally use them?
So I use them. I use them much more long term. I'm not a swing trader, and so I'm not really looking at weekly. I'll only look at weekly if something dramatic has happened and I want to see a much tighter view of what happened.
Yep.
But for the most part, I'm using long term charts and I'm following the trends and I'm looking for levels of long term support or long term resistance, and then making a decision based on that. And then, I have my shopping list, right, that I keep track of. So that's because I do this every day, I get to keep track of it every day. But if you're a doctor and you're not doing it every day, you should at least have if you're doing it yourself and you're not having an asset manager or someone manage your portfolio, then you should know what you own. You should know why you own it. If they're individual names, then you better be sure that you're on top of the story. And look, like I own Apple, right? I own Apple because fundamentally it's Apple. Now, if they have one bad quarter and the stock trades off, did that change the complete fundamental story? No, but it might be enough for me to perk up my ears a little bit and just listen to see what happens next. But until the story fundamentally changes for me, I'm not selling it. And you can see these stocks swing, but they're swinging just because they're swinging with the market sentiment, right? But if their fundamental story on why I bought them remains intact, why am I selling them? Right? I take my dividends, I automatically reinvest them. I don't need dividends for income, so I'm not taking cash. I have everything set on automatic reinvestment. So every time a dividend payment gets paid, I don't even have to do it, just automatically gets reinvested into the stock, right? Which is the other thing I would tell everybody to do. If if you have two accounts, one's a long-term account, one's your trading account. Forget your trading account.
Yeah.
I'm talking about just your long-term account. You should make sure that you have automatic dividend reinvestment. Don't do it yourself because you forget or whatever, but just set it up in your Fidelity or your TD Ameritrade or Robinhood, God forbid if you're using Robinhood, to have it automatically reinvested.
Yeah.
Right? Because that's what's going to help you anybody build long-term wealth. But it starts when you're 24, not when you're 64.
Yep.
You know what I mean?
Yep, for sure. And yeah, this has been fantastic. I love the stories. This has been awesome. I always like to kind of close it out with kind of one last question. What kind of final piece of advice would you give to everybody watching or listening about, taking into account your experience, your time in the markets? What would you say to somebody my age about, building wealth and getting the most out of the markets?
So I would say a couple of things. I would say learn how to not be emotional, right? Because it's the emotions that end up blowing you up because there's a reaction, or you're married to the name, or you love the stock. Meanwhile, the fundamental story's changed, but you refuse to see it, and you're married, and right? So you can't get married to the name. Make sure you're right. While I love my stocks, the minute the fundamental story changes, I'm out. That's just the way I've trained myself, right? So don't get married to them. Don't be emotional in your decision. Don't pay no attention to the noise in your long-term account. In your day trading swing account, you have to listen to the noise because the noise is what makes it move. Right. But in your long-term investment account, eliminate the noise. Eliminate the bullshit, right, that you see on Twitter or LinkedIn, or somebody's making a comment. You got to eliminate that noise, and you have to focus on the reason you bought it, the research you did, why you bought it. Is that story still intact? And if it is, you stick with the name. Right. And then, like I said, sign up for automatic dividend reinvestments, because over time, initially, maybe it's small because your positions are small. But as you continue to grow, suddenly those dividends and those reinvestments become more significant, right? Over time. So as a long-term investor, in terms of building long-term wealth, right? Which is separate from your day trading swing account, right? And if you have a day trading swing account, then you have to be prepared. You have to go in with the mindset that you're going to lose it all. So put whatever that number is that you want to put in there, pretend that if I lost it all, is it going to change my life? Right? Now, as you get more successful, that number may get bigger, but don't put so much in it. Listen, at the risk of sounding like an old man, you're 24 years old. You should absolutely have a Roth IRA. You should be participating in your 401k. You should be putting the money away in the long-term account. Then you can have your Mad Money account, right? But that's going to be money that you, in your mind, if you say, if I lost this money, would I be able to pay my mortgage or pay my rent or put food on the table or buy clothes or pay the electric bill? That's what you have to think about, right? That's what anybody should really think about. But
Mhm.
you know, to a person who's just starting out, or so, you know, whether they're 24 or 44, if they're just
Yeah.
starting out, those are the things they have to pay attention to. And you should take advantage. You should take full advantage of any tax advantage accounts.
Yeah.
You, your wife, your girlfriend, your partner, your boyfriend, or whatever it is, you should all be taking advantage of those tax advantaged accounts.
Yep.
Because those are the ones, if you own those positions, like if I sell my Apple now, I have a huge gain in it, but it's in a tax advantage account. So therefore I have there's no issue, right? But if I did that in my investment account, it would be a big issue.
Mm-hmm.
So you have to understand, you should have every advantage, and every advantage means you should be participating in every retirement account that you can possibly participate in, right? Yep. And if you can't max it out, that's okay. Start with $100. Start whatever it is. You got to start putting something.
Yeah.
Right. That's what I would say.
Yeah. Perfect. Kenny, again, this has been super fun. I love the stories, going back and hearing about what was going on the floor. Where can people learn more about you, your style? I know you've got an excellent newsletter. I really enjoyed your YouTube channel as well with the cooking I was telling you earlier. So yeah. Where can people? What's the best place to reach out to you and learn more?
So you can find me in a couple of places, right? You can find me on my work site, which is casecapitaladvisors.com, but Case is K-A-C-E, Capital Advisors. I also have a personal website, kennypolcari.com, which will give you all my information, as well as access to my daily letter and my videos and all that stuff. You can find me on Twitter at Kenny Polcari. You can find me on Fox Business Network. I'm across a range of their programs almost every day of the week. Just Google me, you'll find me.
Yep.
And
Perfect.
It's all good.
Yep. And we'll have those links down below in the description, so you should be able to find them there. So yeah, thanks so much, Kenny, once again, and to everybody watching. I hope you enjoyed. I know I did a ton. Leave a like down below and subscribe if you're new to the channel, and we'll see you guys in future videos. Take care.